AI is not replacing humans because it is smarter. It is replacing humans because it is cheaper. That is the real story. Every technological revolution promised productivity. Steam power multiplied labor. Electricity industrialized it. Computers automated calculation. But AI is different in one critical way. It does not just increase worker productivity. It replaces cognitive labor directly. And it is happening faster than economic systems can adjust. Companies are not experimenting anymore. They are restructuring. Customer service is automated. Content creation is automated. Legal research is automated. Coding assistance is automated. Marketing optimization is automated. The speed is not gradual. It is exponential. An exponential change collides violently with linear systems. Labor markets adjust slowly. Education systems adjust slowly. Regulatory frameworks adjust slowly. But capital reallocates instantly. If AI reduces cost by 30%, shareholders demand it. If automation increases margins, executives implement it. The economic logic is straightforward. Replace higher-cost labor with lower-cost automation. Increase profitability. Increase valuation. At scale, this shifts income distribution. Less labor income. More capital income. Less wage growth. More margin expansion. And when wages stagnate while productivity increases, demand weakens. Because workers are also consumers. This is the paradox. AI boosts productivity. But if income shifts too aggressively away from labor, consumption weakens. And modern economies are demand-driven. Replacing humans too quickly risks destabilizing the very system that allows AI investment to flourish. This is not a moral argument. It is structural. Technology does not destroy economies. But transition speed determines shock magnitude. If displacement outpaces absorption, instability increases. If companies replace 10 workers with automation but only 2 new roles are created, structural unemployment rises. And if structural unemployment rises while debt remains high, default risk increases. We are not just witnessing innovation. We are witnessing income reallocation at unprecedented speed. The real question is not whether AI is powerful. It is whether the economy can absorb its power without breaking. The economic incentive to replace humans. AI adoption is not ideological. It is financial. Companies operate under margin pressure. Public companies are measured quarterly. Private companies compete on cost efficiency. If AI reduces payroll expense, it improves margins immediately. Payroll is one of the largest operating expenses for most firms, especially in service industries. Customer support, accounting, marketing, design, content moderation, administrative roles. AI can now assist or partially automate many of these functions. Not perfectly, but sufficiently to justify cost savings. Consider this equation. Labor cost per employee equals salary plus benefits plus taxes plus training plus turnover risk. AI cost equals subscription plus infrastructure plus integration. Even if AI performs at 70% of human quality, if it reduces cost by 50%, the financial incentive is overwhelming. Executives do not need AI to be perfect. They need it to be cheaper. When capital markets reward efficiency, adoption accelerates. Firms that delay automation risk falling behind competitors who automate early. Automation becomes competitive necessity, not optional innovation. The result is sector-wide restructuring. When one firm automates and improves margins, competitors follow. This creates industry-wide labor pressure. Now consider macro implications. If companies increase profits by reducing labor, profit share of GDP rises. Labor share declines. Historically, labor share stability supported middle-class consumption. But if automation compresses wage growth, consumption growth weakens. Weak consumption pressures corporate revenue. Corporations may offset through global expansion or price increases. But if automation is widespread, wage pressure becomes systemic. There is also skill polarization. High-skill AI engineers and capital owners benefit disproportionately. Middle-skill cognitive roles face compression. Low-skill physical roles remain until robotics advances further. This widens inequality. Inequality affects aggregate demand patterns. High-income households save more. Lower-income households spend more. If income shifts upward, savings increase relative to spending. Higher savings can drive asset inflation. But consumption may stagnate. Modern economies depend heavily on consumer spending. If wage growth slows significantly, credit expansion must compensate. But debt expansion cannot grow infinitely. This connects directly to previous episodes. Debt sustainability depends on income growth. If AI suppresses wage growth while debt remains elevated, fragility increases. Another structural incentive is risk reduction. Humans make errors. Humans leave jobs. Humans require management. Automation reduces unpredictability. Executives value predictability. Predictability stabilizes projections. Stable projections improve stock valuations. Thus, automation increases financial stability for firms, but may increase instability for workers. Labor markets can adapt, but adaptation requires time. Res-killing, education, mobility, policy support. The problem is not automation itself. It is transition velocity. If adoption spreads faster than labor absorption, unemployment increases temporarily. Temporary unemployment becomes structural if retraining lags. Structural unemployment increases fiscal strain. Fiscal strain increases sovereign borrowing. Sovereign borrowing connects back to debt sustainability. Everything is interconnected. AI replacement is not a tech story. It is a macroeconomic shift. The economic incentive is clear. Replace cost with capital. Increase margin. Increase valuation. But macro systems are more fragile than balance sheets. Replacing humans may optimize companies. But if done at scale without absorption mechanisms, it may destabilize the broader economy. And that is where things start going wrong. The labor market distortion nobody is measuring. The impact of AI on employment does not begin with mass layoffs. It begins with hiring freezes. That distinction matters. When companies expect automation to replace roles, they do not immediately terminate large segments of staff. Instead, they stop replacing departing employees. They reduce entry-level hiring. They delay expansion. They restructure teams. This slows labor market absorption quietly. Official unemployment numbers may remain stable at first. But beneath the surface, job creation weakens. And for new graduates, career entry becomes narrower. This creates what economists call labor market scarring. When young workers cannot enter stable career paths early, long-term income trajectories weaken. This is not temporary friction. It alters lifetime earnings potential. Now consider mid-skill cognitive workers. Administrative staff. Junior analysts. Content creators. Support teams. AI tools now assist or partially replace many of these tasks. Companies can maintain output with fewer employees. So instead of expanding headcount as demand rises, firms increase output per worker. Productivity increases. But employment growth slows. This creates a paradox. Productivity is rising, but labor demand is stagnating. Historically, productivity growth created new industries. Mechanization reduced agricultural labor but expanded manufacturing. Automation in manufacturing reduced factory roles but expanded services. The question now is whether AI will create enough new categories fast enough to offset displacement. The speed difference is critical. If job destruction happens faster than job creation, unemployment rises. If job creation is concentrated in high-skill areas, inequality widens. The economy may grow in aggregate, but labor participation declines. Another distortion is wage compression. If AI performs entry-level tasks cheaply, employers gain bargaining power. Wages stagnate. Even if layoffs are limited, wage growth slows. Slower wage growth reduces consumption growth. Reduced consumption affects revenue. Revenue pressure feeds back into automation incentives. This is the loop. AI reduces payroll. Reduced payroll suppresses wage growth. Suppressed wage growth weakens demand. Weak demand pressures margins. Margin pressure accelerates automation. Acceleration widens displacement. Now consider geographic distribution. High-tech urban centers may benefit from AI expansion, but regions dependent on administrative and service roles may struggle. Regional inequality increases. Migration pressures rise. Political tension intensifies. Economic systems are not purely financial. They are social. Rapid labor displacement stresses social systems. Safety nets. Retraining programs. Unemployment insurance. Public finances must absorb transitional cost. If displacement scales nationally, fiscal burden rises. And if fiscal burden rises while debt is already elevated, pressure compounds. The labor market distortion is not always visible in unemployment rates. It shows in participation rates. Underemployment. Gig work expansion. Multiple part-time roles replacing one stable job. This shifts economic security. Insecure income reduces spending confidence. Spending confidence drives demand stability. Demand stability supports corporate revenue. The paradox deepens further when AI adoption increases corporate valuation. Technology firms benefit. Investors benefit. Stock indices rise. This creates wealth effects for asset holders. But asset ownership is concentrated. If wealth gains are unevenly distributed, consumption impact is limited. Wealthy households save more incremental income. Lower income households spend more. If income shifts upward, aggregate savings rise. High savings can inflate financial assets further. Asset inflation increases wealth inequality. Inequality reduces consumption elasticity. Reduced consumption elasticity weakens multiplier effects. The system becomes more dependent on credit expansion to maintain demand. But credit expansion relies on stable employment and wage growth. If wage growth weakens, debt sustainability weakens. This connects back to earlier episodes. Debt, leverage, and AI are not separate stories. They interact. There is also the productivity illusion. AI may increase output metrics. But if output does not translate into widespread income growth, aggregate demand weakens. GDP can grow while median wages stagnate. Headline growth masks structural imbalance. The risk is not immediate collapse. It is slow erosion. Labor displacement does not need to be catastrophic to destabilize. It needs only to persist. Now consider policy response. Governments may propose retraining initiatives, digital upskilling, innovation investment. But retraining takes time. And not all displaced roles map easily into new industries. The scale of cognitive automation may exceed historical precedents. Unlike mechanization, which primarily replaced physical labor, AI targets analytical and creative functions. This alters the skill pyramid. High-skill roles become more valuable. Mid-skill roles compress. Low-skill roles remain until robotics advances further. This barbell labor market structure increases inequality. Inequality increases political instability. Political instability influences fiscal policy. Fiscal expansion to offset displacement increases deficits. Deficits increase debt. debt sustainability becomes more fragile. The distortion is not visible in a single data release. It builds slowly. Hiring slows. Wage growth plateaus. Participation declines. Gig work expands. Productivity numbers look strong. Stock markets rise. But beneath the surface, labor absorption weakens. This is where things start going wrong. Not because AI is powerful, but because the transition speed is misaligned with economic adaptation. The AI investment bubble forming beneath the surface. When a technology promises productivity gains at scale, capital moves quickly. When it promises labor replacement and margin expansion, capital moves aggressively. AI is not just a technological shift. It is a capital magnet. Venture funding is flowing into AI startups. Public markets are rewarding companies with AI exposure. Corporate earnings calls emphasize AI integration. Valuations are expanding based on future automation potential. But there is a structural risk in rapid capital concentration. When investment floods into a single theme, allocation quality declines. Not every AI application generates sustainable revenue. Not every automation project delivers long-term margin expansion. But during early cycles, investors price in best-case scenarios. This creates narrative inflation. The story becomes more valuable than the balance sheet. We have seen this pattern before. Internet infrastructure in the late 1990s. Housing derivatives in the mid-2000s. Clean energy waves in the early 2010s. Electric vehicle speculation more recently. Each wave began with legitimate innovation. Each wave attracted capital. Each wave overshot realistic revenue timelines. The AI cycle has similar characteristics. Massive projected addressable markets. Rapid user adoption. Enterprise integration promises. Hardware demand spikes. Cloud infrastructure expansion. Revenue growth in key firms. All of these are real. But valuation expansion often runs ahead of monetization clarity. If companies invest heavily in AI infrastructure based on projected efficiency gains, they assume demand growth will justify that investment. If labor displacement suppresses wage growth, demand may not expand as expected. This creates a macro contradiction. AI increases productivity and profitability at firm level. But if it reduces income distribution broadly, aggregate demand may soften. If aggregate demand softens, corporate revenue growth slows. Slower revenue growth challenges elevated valuations. Elevated valuations depend on sustained optimism. Optimism depends on growth confirmation. If growth confirmation weakens, repricing begins. Another structural risk lies in capital misallocation. When funding flows disproportionately into AI projects, other sectors may experience underinvestment. Capital allocation imbalance can create fragility. Overcapacity in AI infrastructure. Underinvestment in physical supply chains. Concentration risk increases. Market indices become heavily weighted toward AI-linked firms. If sentiment shifts, index volatility increases. Now consider leverage. If investors use margin to amplify exposure to AI equities, price swings intensify. If hedge funds concentrate portfolios in AI leaders, correlation risk increases. If retail investors chase AI momentum late in the cycle, volatility increases further. This creates bubble mechanics. Narrative acceleration. Price appreciation. Increased media coverage. More inflows. Further appreciation. Then a trigger. Triggers do not need to be catastrophic. A revenue miss. A regulatory concern. A margin compression event. A slowdown in enterprise spending. Once sentiment shifts, momentum reverses. Capital exits quickly. Valuations compress. Companies dependent on inflated stock prices to raise capital face constraints. If those companies also invested aggressively in infrastructure, balance sheets tighten. Tight balance sheets reduce hiring. Reduced hiring amplifies labor displacement impact. This is where AI replacement risk intersects with bubble risk. If AI reduces labor demand and then AI investment collapses, the economy faces double pressure. Labor displacement from automation and capital contraction from valuation repricing. This is the structural concern. Not that AI fails, but that expectations overshoot. Overshoot creates fragility. Fragility increases sensitivity to macro tightening. Now layer in interest rates. High rates increase discount rates. Higher discount rates reduce present value of future earnings. Growth stocks become more sensitive to rate shifts. If AI valuations depend heavily on future growth assumptions, they are sensitive to monetary policy. If central banks remain restrictive to control inflation, valuation support weakens. If inflation returns and policy tightens further, risk premiums rise. Bubble dynamics become unstable. The danger is not innovation. It is concentration. If too much of the market's growth narrative depends on AI, diversification weakens. When diversification weakens, systemic volatility increases. And if that volatility coincides with labor displacement, economic confidence erodes. Confidence connects back to debt sustainability. If households fear job insecurity and markets correct simultaneously, spending contracts. If spending contracts, corporate earnings decline. If earnings decline, valuation pressure intensifies. The loop tightens. AI is transformative. But transformative technologies historically go through overvaluation cycles. The economy can absorb innovation, but it struggles with synchronized labor displacement and capital mispricing. And that is where things begin to go horribly wrong. When productivity breaks the economy. At first glance, higher productivity should make economies stronger. More output per worker. Lower production costs. Higher efficiency. Greater innovation. Historically, productivity growth increased living standards. But productivity only strengthens an economy if its gains are distributed in ways that sustain demand. That is the structural tension with AI. If productivity rises while labor income stagnates, output can increase without equivalent purchasing power growth. And modern economies are demand-driven. Roughly 2/3 of GDP in developed economies comes from consumption. Consumption depends on income stability. If AI reduces payroll growth, even gradually, it weakens consumption growth. If consumption growth weakens, revenue growth slows. If revenue growth slows, investment slows. Slower investment reduces long-term growth potential. Now consider the paradox more deeply. AI increases efficiency. Firms produce more with fewer workers. Margins improve. Stock prices rise. But if labor share declines meaningfully, aggregate income shifts toward capital. Capital owners save more than workers. Savings rise. Spending does not rise proportionally. Excess savings may flow into financial markets. Asset prices inflate. But real economic demand stagnates. This creates a bifurcated economy. Strong financial markets. Weak wage growth. Rising asset values. Fragile household balance sheets. The system becomes increasingly dependent on credit expansion to bridge the demand gap. Credit expansion supports consumption temporarily. But rising debt increases fragility. We have already discussed debt sustainability. If AI suppresses wage growth while household debt remains elevated, default risk increases. Default risk pressures banks. Bank pressure tightens credit. Tighter credit weakens consumption further. This is how productivity can destabilize rather than strengthen. The economy requires balance between production and purchasing power. If purchasing power lags persistently, imbalance builds. There is also a geopolitical dimension. Countries that automate aggressively may experience short-term profit expansion. But if automation reduces employment too rapidly, social stability weakens. Social instability affects political decisions. Political decisions influence fiscal policy and regulatory response. Regulatory pushback against AI may intensify if displacement becomes visible. This creates policy uncertainty. Policy uncertainty reduces corporate investment appetite. Reduced investment slows innovation momentum. The transition becomes volatile. The long-term promise of AI may remain intact, but the transition may be disorderly. And disorder is destabilizing. There is also the question of reskilling capacity. Can education systems pivot quickly enough? Can displaced workers transition into high-skill AI roles? Realistically, not all can. The demand for elite AI engineers is high, but the number of displaced administrative roles may be far larger. Skill mismatch becomes persistent. Persistent mismatch reduces labor force participation. Lower participation reduces potential GDP. Lower potential GDP increases debt to GDP ratios. Debt sustainability tightens further. Everything connects. Another overlooked risk is corporate overconfidence. If firms assume AI guarantees permanent margin expansion, they may overinvest. Overinvestment leads to excess capacity. Excess capacity reduces pricing power. Reduced pricing power compresses margins. Compressed margins weaken earnings. Weak earnings pressure valuations. Valuation pressure tightens financial conditions. Financial tightening affects employment. Employment contraction affects demand. Demand contraction affects revenue. The cycle accelerates. The danger is not AI itself. It is misalignment. Misalignment between technological speed and economic absorption. Misalignment between productivity gains and income distribution. Misalignment between capital expectations and consumer reality. If AI is introduced gradually, with policy adaptation and income redistribution mechanisms, the economy can absorb it. If adoption is rapid and concentrated, volatility increases. Replacing humans with AI is not inherently catastrophic. But doing so without structural adjustment can destabilize. The economy is not just a productivity engine. It is a demand system. If too many consumers become insecure, the engine slows. AI promises extraordinary efficiency. But efficiency without balance creates fragility. And fragility under tightening financial conditions can escalate quickly. This is why replacing humans with AI can go horribly wrong. Not because AI is powerful, but because the economic system is delicately balanced. And rapid reallocation of income and labor tests that balance. Artificial intelligence is not the villain. It is a tool. A powerful one. It can increase productivity, reduce friction, accelerate innovation, improve decision-making. The danger is not capability. The danger is imbalance. When companies replace labor faster than the economy can absorb displaced workers, pressure builds. When income shifts too aggressively from wages to capital, demand weakens. When investment floods into one narrative, misallocation risk increases. And when misallocation collides with macro tightening, volatility follows. History shows that transformative technologies eventually integrate successfully. But the transition is rarely smooth. The steam engine disrupted agriculture. Electricity restructured industry. Computers displaced clerical work. Each shift created new opportunity. But each also created periods of instability. AI may follow the same pattern. The difference today is speed. Adoption is faster. Capital flows are larger. Financial markets are more interconnected. And global debt levels are higher. That combination reduces margin for error. If productivity gains are matched with income adaptation, retraining, and policy adjustment, the economy can absorb the shift. If not, structural fragility increases. Replacing humans with AI is not automatically catastrophic. But replacing them without structural transition planning can destabilize labor markets, financial markets, and fiscal sustainability simultaneously. Innovation must align with distribution. Otherwise, productivity becomes pressure. In the next episode, we move from labor displacement to capital euphoria. Because when AI optimism becomes investment frenzy, expectations outrun fundamentals. And that is where bubbles form. Next, the AI investment bubble. If you want to understand how automation, debt, capital flows, and valuation connect beneath the headlines, subscribe. Not for fear. For structural clarity.